Welcome back. You're watching the FNO show, but the focus remains on earnings. Let's pull up Kalpataru Projects and see what the stock is getting up to. It's been a pretty solid quarter for the company. It'd be good to know what it looks like going ahead as well. The stock, though, not looking great for some reason, even though they've had a beat on top line and bottom line. Amit Uplenchwar, Director of Kalpataru Projects, now joins it. Amit, good morning. I know the stock performance right now doesn't reflect how well you've done for the quarter, but we'll put it down to a weak market sentiment. It's been a good quarter. Your top line has seen an impressive improvement. Revenues are up 22%. EBITDA is up 36% on back of strong execution. Margins have also improved. Going into FY25, help us understand what we can expect. 20+% revenue growth expected, and what is the margin outlook as well for the FY25?
So thanks a lot for having us on your show. Just a context before I get to FY25, and I think it's important for you and your viewers to know this. We started out in 2021 with a goal of getting to a certain stage at FY25 end of the year, which is a year away. And, we had set out with a $3 billion revenue, $6 billion order book, and a ROCE 20% and above. And I think by the end of the year, we've already breached our order book position. We are at, close to 63,000 crores, including L1 as we speak. Our revenue is at 20,000 crores at a console basis almost, which is up 20% from last year. So we are quite stoked with the kind of performance that the team has done. And as leadership, we are very happy to see this kind of progress. In order, for FY25, we certainly hope that we should be able to continue the streak and get to a 20% revenue growth also for FY25.
Amit, we had L&T's management commenting and post their earnings, even though they posted a good set of earnings as well, indicating that the next 2 quarters will be slow because of elections and execution may be a little bit of a challenge. Do you resonate with that? Are you feeling the same sort of emotion that the next 2 quarters may see a little bit of a downtick before we return back to serious business?
So I think we would have probably thought we could do more than 20%, but there's plenty of factors. One, we are, almost 50% of our business is coming from outside of India, which is robust. Also in India, most of our projects, agnostic of, election outcome, because they are all PSU projects, they're all funded. Yes, in terms of new project guidance for next year, we have to still see how the government outlay pans at the end of the election outcome. And at the end of Q1, we'll be, far more precise in terms of where our guidance could be for FY25 order booking target. But at, the current order book, we are already sitting at 2+ years of revenue. So we are very, very comfortable in terms of our order book positions and the diversification of order across sectors of oil and gas, building, railways, transmission, and water.
Well, right, Amit, we're moving, of course, looking beyond elections and potentially what we can expect from the upcoming union budget. I reckon that a lot of that will also depend on the government in power. That said, at the moment, where do you think, in what areas do you think that there is an opportunity in terms of orders coming through? What do you think that that Kalpataru could do, and what gaps could it fill as we move into FY25? What sort of orders of inflows can we start expecting perhaps as we move into the next couple of quarters?
So, Agam, an interesting question. If you look at our order book split today, we are evenly spread, right? That's a good situation for a diversified company to have. So today, out of my 58,000 crores of order book, I've got almost 35% coming from my transmission, which is both domestic and international. I've got almost 30% coming from my building division and, 19% coming from my building division, and an even spread between water and oil and gas. So, we are across sectors, we've got orders in hand today. And if I look at the future today, the transmission domestic looks, after a lull for the last 3 years, is finally on a big uptrend. Oil and gas international, for which we've been putting seeds for the last 3-4 years in terms of qualification, effort, market intelligence has bore fruit. We've got a very large order in the Middle East for a prestigious global client. And we see that market for us for the next few years looking also robust. Water in India has been a focus for all governments. And for the last 5 years, it had been heightened in terms of Jal Jeevan Mission, river linking, so many different schemes that are announced or to be announced. We've got our building and factories, which is seeing a huge surge in terms of high value project, factory spend coming back again in terms of both government as well as private sector capex. Our urban infra, we've got 2 very large and crucial orders for underground metro using a tunnel boring machine, which also is a segment that has great promise as metros keep expanding across the length and breadth of the country. So looking at our different segments and order, the profile for next few years looks very good.
Just quick mention on the oil and gas space, because you had, in fact, spoken about it right now. There's quite a bit of competitive intensity when it comes to that specific region and orders here. Of course, you've spoken about a client there. Can you give us an idea about the pricing environment, of whether or not that could in fact have some sort of an impact as far as margins go as well?
So I think we've consistently maintained our margin. If you look at the components of margin, in terms of our interest cost, we are stable at 2% of revenue. Our other cost in terms of debt has remained absolutely at the same level as last year, both at net and gross. Very few, hardly any increase for the 20% revenue growth that we've had. We've got our capex for the last 5 years at close to 2,000 crores. And for the 5-year block prior to that was at 1,000 crores. And we've done that all with internal accruals, our debt not going up significantly at all. So looking at that, our oil and gas focus has been to go outside, because in India, oil and gas spend in terms of government capex from PSUs has been slowing down over the last couple of years. The competitive intensity has been quite high. And hence, looking at our oil and gas margins, hopefully we do better outside because the payment terms are better. There is hardly to no retention that is there on our projects. And so we hope that those margins will be better than what it will be in India in that sector, given the competitive intensity.
Amit, just a quick one. This is the Aramco deal you're talking about?
So unfortunately, we are constrained in terms of naming who our client could be because we are in the final
closure
stages of.
Okay.
Yes.
Okay.
But, yeah.
Good luck with that. It's looking good. The stock is up about 100% in the last 6 months. So the euphoria clearly of what we've seen, those order wins from the likes of an Aramco to other big Middle Eastern clients that they've picked up, is reflecting in terms of stock performance and its earnings. With that, completely out of time, but thanks for watching. Up next, there's a lot more programming on the other side, so stay tuned.